The risks of 2008 to 2009 are back in new clothes in 2026, and what Warren Buffett has to say about it. Different times, different headlines, but the same old temptations: too much leverage, flimsy underwriting, overconfidence in good times, and balance sheets that can't take a punch. What investors should do to avoid total collapse according to the Oracle of Omaha. This is what we will discuss now. Buffett's message in the crisis years was blunt. In 2008, he wrote that by late that year, the US financial system had seized up, forcing the Treasury and the Fed to go all in. He expected unwelcome after effects, very likely inflation, and stressed that Berkshire's job was to keep a Gibraltar-like financial position with huge amounts of excess liquidity and modest near-term obligations. He also repeated a rule that matters in every cycle. When investing, pessimism is your friend, euphoria the enemy. In other words, he said when people are fearful, be greedy, and when people are greedy, be fearful. In 2009, he doubled down on the principle that has guided Berkshire for 6 decades. Never depend on other people's mercy to survive. We will never become dependent on the kindness of strangers, humbles, he wrote. Berkshire carries excess cash so that any conceivable cash need is dwarfed by its own liquidity. In the 2008 panic, because Berkshire had that strength, it injected $15.5 billion into the economy at the peak of the crisis, becoming a provider of capital, not a supplicant. Fast forward to 2025 and the song is the same, just with a different beat. At the May 2025 annual meeting, Buffett said out loud what he's always practiced. He spends more time looking at balance sheets than at income statements, often scanning 8 to 10 years of balance sheet history before he even peeks at the income account, because it's harder to hide or play games there. I have a separate video on the channel in regard to the balance sheet risks Warren Buffett looks at. Greg Abel, the future CEO, added that Berkshire will keep a fortress of a balance sheet and never be dependent on a bank or some other party. Translation: resilience first, return second. So what exactly is repeating? Let's connect the dots between the old lessons and today's landscape. In 2008/2009, the lesson was brutal. When leverage meets a funding freeze, even good assets get sold at bad prices. Buffett's remedy was structural: carry lots of cash, keep near-term obligations small, and diversify cash generators so you're the buyer in storms, not the forced seller. In 2025, global watchdogs are saying careful again. The IMF warns that markets look stretched and vulnerable to a disorderly correction, with risks amplified by links between banks and lightly regulated non-bank firms, hedge funds, private credit, crypto. Rising government deficits and tariff-driven inflation pressures add kindling. That's the sort of after effect Buffett flagged in 2008. The exposure is big. The IMF estimates US and European banks have some $4.5 trillion entanglement with hedge funds and private credit groups, exposures that, at some banks, exceed core capital. That's leverage plus opacity, the same 2008 vibes with just a new vehicle. The next issues may arise when shaky underwriting migrates to wherever the rules are looser. Buffett's 2008 letter used Berkshire's Clayton Homes to teach Mortgage 101. Real lending requires meaningful down payments and a payment the borrower can truly make. The national housing bust wasn't mainly about prices going down. It was about borrowers who couldn't service their loans because teaser rates reset and refis vanished. Keeping people in homes required prudent underwriting on day one. Buffett's fix doesn't change. Avoid structures you don't fully understand, prefer counterparties with balance sheets you can evaluate, and above all, don't need those counterparties to bail you out. That's why Berkshire's default setting is piles of T-bills, which stands for short-term bonds and cash, when the opportunity set looks thin. I have a complete video here on the channel on all the major factors Buffett looks for when evaluating the risk of the balance sheet. You can check it out from the link in the description. Again, real estate stress is also bubbling up, same cycle, different segment. In 2008, housing and mortgage finance broke. Buffett wrote about how short down payment loans and fantasy monthly payments were accidents waiting to happen. In 2025, it's commercial real estate, especially offices, that's under pressure. Vacancies are at or near record highs, and an enormous load of refinancing will come due soon. Another risk is the government intervention and the inflation aftertaste. Buffett wrote in early 2009 that extreme policy medicine, dispensed by the money printing barrel in 2008, was necessary to avoid catastrophe, but would bring unwelcome after effects, likely including inflation. He also noted that major industries and even cities and states could become reliant on federal help, and getting them off the teat would be hard. Sound familiar? For 2026, the IMF is again warning that fiscal deficits and political pressure on central banks raise the risk of renewed inflation spikes and market jolts. It's the same caution Buffett offered. Policy saves the system, but it changes the background risks for investors, especially those who mistake low rates or backstops for a permanent free lunch. Why the balance sheet is Buffett's North Star. One reason these risks repeat is that income statements look great until they don't. It's the balance sheet that tells you if a business can endure. The cash, the maturities, the off-balance sheet obligations, the goodwill from pricey acquisitions, the pension promises, things that don't fix themselves when revenue dips. Buffett's 2025 comment, "I spend more time looking at balance sheets. It's harder to hide or play games with them," is not a cute line. It's a survival tool. Greg Abel's add-on, "Fortress of a balance sheet, never be dependent," is the operating rule. This is exactly the philosophy Berkshire used to be a buyer in 2008 and a patient non-buyer when prices and terms aren't right today. For sure, take time to check my balance sheet video analysis, as I have not seen such content on YouTube. I will put it in the description. If you want a practical checklist for 2026, you could reread Buffett's 2008 to 2009 playbook and apply it to today's hotspots. The checklist goes like this. 1. Funding. How much cash and truly liquid assets sit on the asset side? What are the near-term maturities on the other side? Berkshire keeps huge amounts of excess liquidity for a reason. 2. Counterparty and complexity risk. Where does the company rely on non-bank finance or thinly regulated structures? The IMF's 2026 worry isn't just leverage. It's the links between banks and shadow lenders that can transmit shocks. If the chain is long and opaque, demand a higher margin of safety or pass. 3. Asset to loan quality. In 2008, down payments and true affordability separated survivors from casualties. In 2026, ask similar questions about covenant quality, borrower cash flow, and the refi test at today's rates, especially in commercial real estate and private credit portfolios. Good collateral plus realistic cash flow beats fancy structure. 4. Have capital discipline. The balance sheet also reveals past sins, bloated goodwill from overpaying for acquisitions, pension deficits, and serial dilution masked by rosy narratives. Buffett's cure is dull. Buy fairly priced businesses that produce cash, avoid debt that can sink you, and give managers room to run without promising Wall Street a straight line. 5. Be guarded with strong temperament is the next key lesson. In both 2008 and 2025, most commentary focuses on forecasts. Buffett's edge is preparation. Hold cash when bargains are scarce. Swing hard when fear creates them. Don't confuse doing nothing with doing poorly. Sometimes the highest return action is waiting. Be careful in these times. Buy stocks with margins of safety. Have cash on the side and ready to strike gold when the next crisis comes, as each crisis is the greatest opportunity for the long-term investors. Subscribe for more, and I'll see you in the next video.